If you guys follow the market, you know that software companies have been absolutely crushed in the past year or past couple of months. For example, Adobe stock is down 40% in the past year. Salesforce stock is down 36% in the past year. Even bigger companies such as Microsoft are down 20% from its all-time high in the past 3 months, or even smaller companies such as Duolingo, which is down 73% in the past year. And in this video, we're going to take a look at the fundamentals of some of the most popular software companies. We're also going to take a look at the valuation, including running discounted cash flow models on these stocks, because they have gotten very cheap, some of them. And we'll answer the question which has gotten these companies to drop so much in price, which is, will AI kill software companies? And we're going to react with a recent interview made by the NVIDIA CEO on AI's pressure on software stocks. And the first thing that I want to show is that AI has not affected these companies yet. For example, Adobe's revenue has grown from $5.8 billion to $23 billion in the past 10 years. If we take a look at a company like Salesforce, you can also see that their revenue hasn't stopped growing, currently at $41 billion. The Trade Desk company, again the same, growing at almost double digit every year. Shopify stock just reported earnings last week and reported 30% growth in revenue, currently generating $11 billion. A company as large as Microsoft is still growing at double-digit percentages, and even smaller companies such as Duolingo is growing at 38% annually. And the same with the profit of these companies. Let's start with free cash flow. Adobe's free cash flow has grown from $2 billion to $9.8 billion in the past 10 years, so they are at an all-time high in terms of revenue and profit. Salesforce, again the same story, currently at an all-time high of $14 billion. The Trade Desk company, again at an all-time high of $795 million. The Trade Desk is obviously a much smaller company. Shopify, the same story, again at an all-time high of $2 billion. Let's take a look at Microsoft, again at an all-time high of $77 billion, and Duolingo the same. So what I want to show is that these companies are at an all-time high in terms of fundamentals, both in profit and in revenue. And if we take a look at analyst expectations, they are still expecting growth in both revenue and profit for all of these companies. For example, for Adobe, from $26 billion this year to $35 billion in 2030. And as far as profit, from $23 per share to $33 per share. Now, it is true that analysts have decreased the growth estimates for these companies in the next couple of years, but still a lot of growth is expected. Another example is Microsoft. They still have Microsoft growing a high double digit for the next 5 years, which is insane considering how large the company is, and again growing profit at double digit. Another thing that software companies have in common is that they have amazing margins. Adobe's gross margin, for example, is nearly 90%, and their free cash flow margin is currently at around 41%. Salesforce gross margin currently at 77%, and free cash flow margin currently at 35% and improving in the past couple of years. The Trade Desk current gross margin 78%, free cash flow margin 27%. Shopify gross margin of 50%, so the lowest yet, and free cash flow margin currently at 17%. And Microsoft gross margin at 70% and free cash flow margin at 25%. And then finally, Duolingo gross margin at around 70% and free cash flow margin at around 35%. So what I wanted to show you guys with this is that software companies have amazing margins, the best out there. Another positive about some of these companies is that management has decided to buy back shares. For example, a clear example is Adobe. As the company has gotten cheaper, the company has decided to buy back more and more shares. This is huge for investors because you own more of the company and you have to share the profits with less people, and also aligns with the vision that management thinks the company is undervalued. Another example is Salesforce. As you can see, in the past couple of years, they've bought back again 1 or 2% of their shares annually, well before they were issuing shares. And another positive about software companies is that they have amazing balance sheets. For example, Adobe has $6 billion in cash and $6 billion in debt, so they can pay off this debt whenever they want. The Trade Desk company, for example, has more cash than debt, $1.3 billion in cash and $436 million in debt, or even Shopify, that has $5 billion in cash and only $188 million in debt. So again, a huge positive about software companies is their balance sheet. By the way, if you want access where I'm showing all the stock data in this video, you have my link to stockanalysis.com in the description and you can get a discount code. But now let's talk about the valuation, because a lot of investors are getting interested as these companies compared to their historical are trading quite cheap. What you have here is the price to free cash flow for these 5 companies in the past 3 years. And let's start, for example, with Duolingo, which used to trade at a price to free cash flow of 50 or 60 and now trading at a price to free cash flow of 12 right here. Another company is the Trade Desk, used to trade, as you can see here, 70, 100, then came all the way down and now trades at a price to free cash flow of 14. The most expensive out of these ones right here is Microsoft, which used to trade at a price to free cash flow of 50 and now at 37, although it has traded at around 37 in the past. And Adobe is extremely cheap at the moment, currently at a price to free cash flow of 10. One of the most expensive companies at the moment is Shopify. In fact, if I put in Shopify in this comparison tool chart that again Stock Analysis have, it would be the most expensive with a price to free cash flow of 78 and with a lot of difference compared to the next ones. But the price to free cash flow is only one metric. And in order to take a deeper look at the valuation, I use my Google Sheet or discounted cash flow model, which tells me at what price you should buy a stock based on the assumptions about the future of the company that you put in. I did a 7-year analysis with low, middle, and high assumptions. And as you can see, the intrinsic value according to my low assumptions is $274 per share, middle $389, and high $537. Now the stock is currently trading at $262 per share, which means that if my low assumptions occur, you would get a 10.9% annual return on your money, middle 17.6%, and high 24%, which are insane returns, especially considering how conservative my assumptions were. For example, I have Adobe growing revenue between 4% and 8% over the next 7 years, averaging a profit margin and free cash flow margin between 30 and 40%. Keep in mind they are currently doing 40%. And I assigned the PM price to free cash flow at the end of the 7 years of 16, 18, and 20, and I didn't even assume any share buybacks. Then the Trade Desk company, ticker symbol TTD, is another company that looks heavily undervalued. I have intrinsic value between $29 and $53 per share, and the stock is currently trading at $24 per share, meaning that if my low assumptions occur, you would get a 13.5% annual return on your money, middle 19.5%, and high 25%. If you want to check the assumptions, you can pause the video. I'm not going to explain every single one of them. By the way, if you want access to a spreadsheet and make your own assumptions, I'm going to leave a link to a spreadsheet down below. Super simple to use because I've done all the calculations in the background, so you only need to input your assumptions. But not all companies are undervalued at the moment. In my opinion, Shopify is still a bit expensive. As you can see, have intrinsic value between $42 and $118 per share, and the stock is currently trading at $121. And then Microsoft is a company that is started to get really interesting. I have intrinsic value between $321 per share and $592, and the stock is currently trading around $393. So I would say it's trading around fair value or even slightly discounted. And Microsoft is a beast of a company, so it's definitely on my radar at the moment. And Salesforce, ticker symbol CRM, is another company that looks really interesting at the moment, as I have intrinsic value between $227 per share and $430 per share, and the stock is trading at $195 per share. And as far as returns, 12.8% according to my low assumptions, 19.2% according to the middle, and 25.5% according to the high. So the point is, a lot of these companies look really good in terms of valuation at the moment and could offer a huge opportunity. Now the big question is AI going to kill these stocks completely, and is it not worth investing in these companies at all? But first, I want you guys to hear what Jensen Huang has to say about the future of software stocks and AI's pressure on them, because he's the CEO of NVIDIA. So he's one of the leaders in the AI revolution, and then I share my thoughts and also talk about what stocks I'm buying if I'm buying any.
You think about the software industry, the SaaSgeddon that they've been calling it. You look at law firms, cybersecurity firms last week, and then IBM shares this week had their biggest drop in a quarter century. Is that overdone by the markets, or do you think there's a real good reason that investors are looking at this and saying, this is going to change everything for these industries that have been so entrenched?
Deeply, I think there's a deep misunderstanding. What Claude is definitely revolutionary, and it's an inflection point for AI. It's the first time that AI can perceive, it can reason, but it can also do work. It actually performs tasks. Like, for example, it can write software. It could create a website for you. It could arrange a vacation for you. And so it can actually perform tasks. And that's the reason why we call them agents. They're agentic in their nature. What software companies, the reason why it's so exciting, of course, is because it can write software. What's going to happen are the tools companies, the platform, the ISVs, the SaaS companies, the tools companies, they will use agentic systems to develop their software. But enterprises are not going to go develop software. They're going to use agents to use those tools. And so what's likely going to happen is that agents won't replace the tools, but agents will use tools. That's the reason why we also say agents are tool users. Why write rewrite the browser when the browser exists and just use it? Why rewrite Excel when Excel exists, just use it? And so all of these tools that we use today, whether it's Cadence or Synopsys or ServiceNow or SAP, these tools exist for a fundamentally good reason. And AIs, these agentic AIs, will be intelligent software that uses these tools on our behalf and help us be more productive. And so what's likely to happen, and this is very counterintuitive, it's very likely that because we have so many agents in our company now, the tool use will actually go up. And so, and you could see it all over the place. The number of C compilers that we use, the number of Python programs that we have, the number of instances are growing very, very fast because the number of agents we have that use these tools are going up. And so I have 42,000 biological employees, and I'm going to have hundreds of thousands of digital employees, and together we're going to use a lot more tools.
But that means that you think that they're not going to disintermediate these companies like a Salesforce or so many of the others along the way. You think they'll still be using those tools coming from those companies that are being sold off right now by the markets?
I think so. I think the market's got it wrong. I think it's very likely that these companies that we're talking about are going to introduce agents that run on their platforms. These agents, of course, they have to be experts in what they do, and nobody's going to understand customer service better than ServiceNow, and they're going to come up with agents that are really fine-tuned and optimized for the type of work that uses the tools that they have. In the end, also, we need the tools to finish their work and put the information back in a way that we can understand, and that we call them system of records. And so each one of these tools have their own system of records. Those system of records exist because we put them there and we use it so that we understand the information that's finally complete. And so those system of records will still be ground truth, and they'll continue to be ground truth. And now the agents will help. They will use it, and they will populate the system of records. They will use the tools that are available on these platforms. I think a thought experiment that could be helpful is, imagine one of these days when we have robots and these robots are in our homes. It's very unlikely that the robot will come up with a new Cuisinart. The robot will just read the manual for the Cuisinart and just use the Cuisinart. It's more likely that instead of coming up with another way of doing microwaving, that the robot will just use the microwave. These tools exist for a good reason. And so I'm fairly certain future robots will use screwdrivers and wrenches and pliers and things like that. And these tools are essentially in their digital form from the companies that you're talking about.
So they're not going to replace the tools. They're just going to replace us, the humans that use all these tools to begin with. That's an interesting thought experiment. I like it. They're going to help us. They're going to help us. Okay, we'll take that.
They're going to help us. Yeah, they're going to help us. And the reason for that is because, as it turns out, that for most of our software engineers, coding is what they do, just as for a CEO, typing is what I do. But the purpose of the typing, the purpose of the coding is solving problems and solving problems that we haven't even thought of solving. That's called innovation. And so the purpose of the work won't change. And so we're going to need lots and lots of software engineers. But maybe they just don't have to code like they used to code. They'll code in a new way. They'll code in they'll describe to the agents what their intentions are, what kind of ideas they have, and the agents will write the actual software. And so, we'll work at a different level of abstraction. We'll be a lot more productive. Hopefully, create a lot of new things and solve a lot of new problems.
As you have listened, Jensen Huang does some very good points. The first being that agents won't replace the tools but are going to end up using the tools. For example, if you already have Microsoft Excel, why would you redo it? And what I believe is going to happen is that companies like Adobe or Shopify are going to have AI integrated features, which they are already doing, by the way, but I think it's going to happen at a larger scale. So AI is going to change software, there is no doubt, but it's going to be integrated in them rather than replacing them. Jensen Huang also said that we're going to use a lot more tools of software, which I also agree on. And these companies, I believe, are going to continue to grow their revenues. And he believes the market got it wrong. However, we need to take into account that he definitely has a bias, which is why we need to think on our own, but it is good to listen what he has to say. That being said, I do not believe all software companies are in the same situation. We also need to think about the moat of sub-companies and the switching cost from a customer perspective, which is why I have doubts on some companies like Duolingo or DocuSign. And in my opinion, not all software companies are cheap. Shopify is an example of a software company that I believe is still expensive. And taking everything into account, I believe Adobe is a great buy at the moment, which is why I have a position, but remember that this is not financial advice and you should always do your own research. I hope you found this video valuable. Let me know what you think about software stocks in the comments and I'll see you in the next one.